He has worked in distinguished organizations like the Kotak Mahindra Group, SBI Capital Markets, and ITC Bhadrachalam. He has worked in Kotak Mahindra Group for over 20 years, with the last 15 years with Kotak Mahindra Asset Management, first as a fund manager and for 9 years as its chief executive officer. In his career, he has received numerous awards and accolades for the Best Fund Manager, Best Fund, and the Award for Business Leadership. He was the Vice Chairman of the Association of Mutual Funds and was also on the board of Kotak Mahindra Pension Fund. After about 25 years of experience in financial services, Mr. Sandesh Kirkire is now an angel investor working with startups with an impact investment fund and in academics. We welcome you to the SMIC finale, sir. Tushar Lovalekar. He worked with RBL Bank, Ratnakar Bank Limited from January 2014 to November 2014 as the zonal head, rest of Maharashtra and Goa. Also as a part of the CSR committee of the bank, the committee is responsible for implementing the CSR strategy of the bank. He worked also with RBS, formerly ABN AMRO Bank from 2003 to 2013 as a vice president, cluster head, rest of Maharashtra and part of Gujarat, and director employee of RBS Foundation India from 2009 to 2011. Thank you, sir, for being with us today. Next, we have with us Mr. Dhaval Vakaria. Mr. Dhaval Vakaria has more than 9 years of experience in private equity and risk management consulting, currently working with Avendus PE, a leading provider of financial services with an emphasis on customized solutions in the area of financial advisory, capital markets, wealth management, and alternative asset management to its clients that include institutional investors, corporates, and high net worth families. Prior to Avendus PE, Mr. Dhaval Vakaria has worked with India Value Fund and KPMG. At India Value Fund, he was a member of the team that successfully raised US $700 million. He has experience in the field of private equity fundraising, investor relations, debt raising, private equity asset monitoring, valuation, implementation of enterprise risk management and governance framework, Sarbanes-Oxley implementation, and tax and regulatory advisory. He holds a bachelor degree in commerce, a qualified chartered accountant India, and certified internal auditor USA. And for all those who do not know, he was also the founder investor in Samnidhi, the student managed investment fund. Please give him a huge round of applause. We have with us Kishore Bagri, Portfolio Manager for Multi-Asset Products at ING Investment Management Private Limited. He did his Master of Business Administration and Finance from India Institute of Social Welfare and Business Management and his Bachelor of Commerce from St. Xavier's College, Calcutta. He is known for the acumen in conceptualizing, developing, and managing quant strategies and also pitching the strategy to distributors and clients. He is also known for his presentations and trainings on the strategies. Please give him a huge round of applause. Next, we have Mr. Anjan Ghosh. Mr. Anjan Deb Ghosh is Executive Vice President and Chief Rating Officer of ICRA Limited and member of the rating committee of the company. He holds a BTech degree in Mechanical Engineering from Indian Institute of Technology, Kharagpur, and postgraduate diploma in management from Indian Institute of Management, Calcutta. Mr. Ghosh has an aggregate work experience of over 25 years, of which he has been associated with ICRA for over 21 years. Please give him a huge round of applause. Last but definitely not the least, Mr. Vishwanathan MB. Mr. Vishwanathan is a chartered accountant with 10 years of experience across a variety of fields, including corporate finance, buy-side research, sell-side research, consulting and training. In his career spanning 10 years, he has covered the papers and packaging industry as an analyst, advised on the largest insurance asset manager on new product opportunities and go-to-market strategies, advised a leading optical major on M&A, worked closely with fund managers in identifying and evaluating investment opportunity, and trained senior analysts, directors, and managing directors on various topics including valuation, modeling, and presentation skills. In his current role, Mr. Vishwanathan MB serves as a trainer with Citigroup Global Markets, where he coaches from entry-level associates to senior analysts and helps them as subject matter expert on various topics. He graduated in college from He graduated in commerce from Loyola College, Chennai, and holds a ACA, CFA, and FRM certification. Thank you, sir, for being with us today. I would now quickly run you through the rules of the presentation. The 7 teams that are seated here, each team will be given 30 minutes, 15 minutes for presentations, and another 15 for Q&A. Each team will be marked out of 50 on the following criteria: investment rationale, philosophy and risk profile 5 marks, stock selection process, screening criteria and sector overview selection 15 marks, presentation of results 20 marks, response to question 10 marks. Only one member of the team can present, but all the members should be present during Q&A. The first team to present today is team Tradersdrift. There is a reason as to why they are first. They made the maximum profit out of the corpus that was given to them, and I'm proud to be a part of this team. I hope it is not too soon to say this, but yeah. The fund manager for the team is Mr. Tejas Talak, and the presenter for the team is Neha Agarwal. Please give them a huge round of applause.
A very good morning to one and all present here. We, Team Tradersdrift, would now be presenting our investment journey. During the 10 weeks of investment, we had made some 100 mistakes, maybe more than that, but the learnings were definitely a million. I would now like to introduce my team to all of you. So to begin with, we have Preeti Agarwal. Her role has been as a researcher and risk analyst of the team. And to mention, her risk profile has been that of a low to moderate investor. Next we have Mr. Prashant Kaushik. He is a trade executor and the tracker of our team. His risk profile stands to be moderate to low again. Next we have, as already communicated to you, Soumya Verma. She is a risk analyst and script writer for our team. Her risk profile being moderate. Next in line is Mr. Tejas Madhav Talak. He is the portfolio manager for our team, and his risk profile stands to be one of the highest in our teams. Following them all is myself, Neha Agarwal. My role in the team is that of a Bloomberg expert and giving them advice on the same, and my risk profile stands to be that of moderate to high. As you all can see, our entire team as a whole covers the entire gamut of risk profiling, and so it was very difficult for us to come up with a consolidated risk profile for the entire team. Hence, we choose to be moderate to highly risky. Moving forward to our investment philosophy, I would like to take you through paths in this. Now, our investment philosophy stands to be to consistently generate returns in excess of the benchmark returns, that is CNX 100 for us, by creating an equity-based active portfolio of companies. Now, before I move forward, I would like to highlight, as already mentioned by Soumya, that the returns generated by our team has been around 7.20% over a period of 10 weeks. And that of our benchmark has been 6.53%. So logically, we have actually beaten our benchmark. This is something we should be elated about, very glad, because for the first time in our lives that we have invested, we have actually beaten our benchmark. But then we suddenly notice that there's something called a fund cost, which we did not take into account. To specify, a fund cost basically would include all the administrative expenditures, all the salaries that a fund would pay, and assuming that we will not be working in NGOs, so this cost is something which is unavoidable. Taking this into consideration, probably we would not have beaten the benchmark. And this was one of our biggest learnings from the investment. Now moving forward, as I had mentioned that ours is an equity-based active portfolio. Now what the word active really means and how well justified is it in our portfolio, we'll be seeing soon. Moving forward again, the portfolio of companies which we have chosen has 4 key features which are consistent amongst all of them. One is an understandable business model. We all know that it is very important to know the business wherein you invest. it's like when we own shares of a company, we own the company in a part. So we should understand the business, and this has been our primary focus. Next is the moat or competitive advantage that a company might have. In every industry, there's some company or the other which has an edge over the others. To identify such companies and invest in them has been one of our targets. Next is the consistent earnings growth. Definitely there are companies around the world who have given phenomenal results and growth over some periods of time. However, to be consistent is the key. Hence, we look for companies which have consistent earnings growth, so that stability comes in our plate automatically. Now, next is the corporate governance. Good corporate governance is the key to sustainability, as well as a company which is reliable. Even though markets do not perform, if a company has good corporate governance, we can expect, in fact, if the company has all these four, a combination of these, we can expect the company to definitely grow up and move beyond the market fluctuations. Now I would like to take you through some details of our portfolio. As we can see, our investment horizon, already mentioned, had been 10 weeks, and we expected to liquidate after the Union Budget 2015, as we did on the 3rd of March. The portfolio churning, now you would ask, in 2 months, did you churn your portfolio? Did you actually change? Yes, we did. Based on our target price and stop loss breaches, we actually did so. And we had also decided on rebalancing our portfolio fortnightly. The set of companies that we considered has been from a pool of BSE 500 index and NSE and CNX 500. The amount invested as a team, we had a corpus of 1,25,000, that being 25,000 each. And the evaluation process for the companies and stocks that we picked, the basic underlying was a fundamental approach, and we used a mix of bottom and top-down analysis. Our stock picking strategy basically lied in the GARP model, that is the growth at the reasonable price. Now I would like to take you through the GARP model. There are investors that we see in fundamentals who go for value investing, trying to spot stocks which are high on value. And there are some investors who take on growth, so trying to value stocks which are high on growth. But we took the middle way. So this is the GARP model, which stands for growth at reasonable price. And thank God for Peter Lynch, because we were very confused as far as risk profiling is concerned, that which model should we pick, because few of us were keen on growth and few on value. So we had the middle way out sorted between us. Next, we take you through our stock screening criteria. As you can see, there are 5 fundamental criteria, basic ones, which we considered for all our stocks. Okay, so, and this helped us to come down to a pool of 70. The first being market cap to be greater than 300 crores. This was given to us by our mentors, as in our faculty. Next is the positive net income. We considered only those stocks which have had positive net income over the trailing 12 months. Positive free cash flows. Next is the minimum ROCE of 10%. Now, ROCE, that is the return on capital employed, is something which would vary from industry to industry. However, a 10% of ROCE is the minimum that we thought would be good for our fund. Taking into consideration the advices of various analysts in the market and the various articles and journals that we read, this number was more or less a minimum limit for most of the industries that we wanted to consider. Next is the PEG ratio. Now, PEG is PE to growth. Okay, so it's a ratio which stands for price to earnings to growth. Okay, we took this ratio to be less than 2. However, Peter Lynch proposes that it should be less than 1. When we took it to be less than 1, our total pool came down to 35 stocks. So to be little liberal on our markets, we took it to be less than 2. Now, this is a Bloomberg snapshot of how we did our equity screening and came down to a pool from around 582 stocks in our pool of BSE and NSE 500 to 70. Now we would like to take you through how exactly did we come from a list of 70 stocks to the set of the ones we have picked? Firstly, we did industry-wise categorization. Now we classified the 70 stocks into various industries, and then our approach was selection by elimination. Now you might think that it is a little naive method, but we found it suitable given the fact that our basic underlying philosophy was to understand the business model. So for those industries where the model were complicated, at least for us, we found it safer to stay away from, because then it would be difficult for us to understand the impact of any macro or micro scenarios on those companies. Hence, we selected those industries depending upon the primary research and our understanding. Again, as I mentioned, we eliminated industries based on which were highly uncertain for us, and we came down to short list of 6 industries. Amongst the 6 industries, what we did was we actually evaluated each industry and looked into industry level fundamentals. Now, the basic balance sheet and P&L account ratios would vary from industry to industry, and the importance and standards would also. Hence, it was not justifiable to take a set of criteria and set it common for all of them. Hence, we looked into industries specifically, and another important thing which we looked into was the earning surprise element. Now, I would like to mention here that we had referred to a recent paper on Canadian stocks by Chudek Turong and Veera Raghavan, that is our professor himself, which says that, which is basically upon stocks and investing in a horizon of 3 months. So this paper was well fitted for our scheme of things because our investment horizon was 2 months. And one of the lines over there was either one of the 2 criteria, which I will be mentioning now, provide drift, but the combination of 2 create a stronger excess gain. So what are these 2 criteria? The first being high positive earnings surprises as compared to analyst estimates. So generally we all know that there are various analysts tracking various stocks. Hence, they have their estimates and they have their expectations. Companies which meet those expectations or are below them, generally the results are not reflected in the prices because they're already taken into account, right? Because we have expectations from them. But companies whose earnings come as a surprise to the earnings estimates of the analysts are the ones whose results are reflected in the prices. To take a case, there have been companies whose Q3 results have been phenomenal, but the prices did not reflect the same. The reason being that it was expected. Hence, good results does not always mean excellent growth in the prices, especially in a short run. Now, next being high positive earnings growth when compared to corresponding quarter of previous year. Obviously, because given the fact that our investment horizon was 2 months, we took into consideration the results of Q3, and the companies which had high positive earnings growth over the same quarter last year would be our preference. Now we would like to take you through our rebalancing scenarios. As we had mentioned, fortnightly rebalancing is what we considered. Apart from that, there were 2 scenarios. One is target price achieved. Now, it was a consensus in our team to set the target price to 10% upside and a stop loss to 10% downside. Given that the time duration that we had was very low, we did not do a fair value analysis of the company and came up with a target price which could be very fair and justified and way beyond what a normal 10% would be. However, we felt that for a given period of time, 10% would be a good enough number. This again came out as a very good learning for us, which we would be discussing in a short duration of time. Now, the first scenario being, if the target price is achieved, so what would we do? We generally decided upon holding the stock and then revising the position. So then we would revise our target as well as the stop loss, right? So suppose my current price is 100 and I've decided target to be 110. If it reaches 110, I would revise my target and my stop loss would also go up. Because earlier it was 90, so now it would perhaps come to 100. Scenario 2 being stop loss breach. So what if my 100 becomes 90? So our decision was to sell the stock. I would not say this being the most correct decision and that we believe in utterly, but again, because our investment horizon was very less, we could not take the risk of holding on to the stock. Hence, we decided to sell the stock and then take positions in new security. We had another rebalancing scenario which concerns the portfolio. So till now we discussed about individual stocks. If our entire portfolio say hits a downside of 7%, it could be because of two reasons. One being some stocks are more than 7% downside, right? Not all, but there are some stocks which have hit the downside of definitely more than 10%. That is the reason our entire portfolio would be more than 7% on the downside. So what would we do? We would replace the top 50 by value. So top 50% of the stocks would replace by value so that the stocks which are hitting the downside could be eliminated. Next being all stocks at 7% downside. Now if that is the scenario, then we would rebalance our entire portfolio because perhaps the choice of stocks are not inconsistent with the market. Now I would like to take you through the portfolio evaluation, how we have built up our portfolio over the past 10 weeks and what has actually been the result. I would compare our portfolio with that of SBI and ICICI Prudential blue chip funds, and we can see that our beta is 0.922, whereas that of SBI is, that of SBI is 0.82 and ICICI Prudential is 0.96. Similarly, we will take you through Sortino and UPR ratios, and we can see that in terms of Sortino ratio, we are ranking 3. Now, I would like to tell you that Sortino ratio is basically, in a layman's term, we would say that the higher the ratio, the lower is the risk of getting a big loss. Okay, so it's like if my ratio is really high, it means that my probability of hitting a downside is low, a big downside is lower. So in that way, if we see, and our Sortino ratio rank is 3, which is not so good. And then the UPR is the upside potential ratio. So we see that if the markets go up, what is the potential of our fund vis-a-vis the others? So here again, our rank was 3. Looking at these ratios, I seriously wonder how we made what we made. Excuse me for a second. Okay, so now I would like to take you through the performance of our portfolio on a weekly basis. I regret the pause. Now, as we see, the graph here shows the timeline of our portfolio vis-a-vis CNX 100, which we apparently considered as our benchmark. Now the blue line is that of CNX 100 and the green one is ours, and eventually we end up outperforming. If you can see towards the end of the graph, here, so the green line goes above. Now I would like to take you through our weekly journey as to how we performed over the different weeks. Week 1 has been a loss of 0.37%, and if you see our portfolio here, we had a portfolio of 6 stocks and with some cash. The overall profit and loss has been a negative figure of 0.37%. Week 2, we had another negative, further going down to 1.90%. However, we held on to our stocks because none of our stocks had hit the stop loss. Now week 3, we moved up, not only covered our negatives but also the positives, so perhaps the idea of holding on was good. I would like to share something at this juncture, that when students like us, when we invest, and that too for the first time, and we see that the first 2 weeks continuously we are going down and down, it's very disappointing, and the decision to hold on to the stock and to trust your decision, to trust your selection is very difficult. So for that moment and for those times, I think I would really like to thank our faculty mentors who guided us and told us that it's not a good idea to always lose trust on what you had yourself decided and rather wait. And so the results followed. Week 4 was phenomenal for us, with Axis Bank and Wonderla giving excellent returns. Now, one of our stocks was negative, but the others made up for it with an overall 8.14% gain. Week 5, we had